Well, here with his thoughts on the direction of the Treasury market, especially ahead of next week's FOMC meeting, is Dan Greenhaus. He's an analyst at Miller Tabak. He is currently heading the firm's bond strategy team. We're glad to have you with us, Dan. So what is the market going to do? First of all, there's the auctions, right? We should talk about that before we even get to FOMC. So take that away. What should we expect?
Well, later today, we're going to find out the size of the next series of auctions, which are 3-year, 5-year, and 7-year auctions. And the size of those auctions are playing into the general theme that we're seeing right now, which is a growing concern on the part of investors with respect to the supply of treasuries that are coming to market as the government funds many of their programs 100%.
So also talk to me about this idea. We were speaking about it earlier about risk aversion, whether or not it is in the market or not. How do you see that playing out in the Treasury market right now?
Well, at the end of 2008 and the beginning of 2009, the risk aversion theme was a major part of the action in the Treasury market as investors fled all risk assets for the safety of the Treasury market. What you've seen since the quote-unquote bottom in March was a reversal of that trade somewhat as the level of economic contraction abated a bit and investors got more comfortable wading into, for instance, the equity markets, and you saw a repricing of equities in the face of that contraction abatement.
So looking ahead then to the FOMC, I mean, most traders we're speaking with say the Fed is probably not going to change its stance. They're not going to indicate that they're going to raise rates soon. What does this mean for the Treasury market? What does it mean for a fixed income investor?
Well, the most important thing, I mean, they're clearly not going to raise rates. So one of the most important things to take out of the statement is whether they change their wording with respect to the economic outlook. And
just kind of talk it up being bad or just kind of give us some indication, right?
Yep. Or what moves, if any, they make on the quantitative easing program or the credit easing program. They're in the process of purchasing 1.25 trillion mortgage-backed securities. They're purchasing 300 billion treasuries. As yields in the Treasury market started moving higher, there was widespread speculation that they would increase their purchasing of treasuries. They've since given us indications that they won't do that anymore, and to what degree do they alter their language on that front in the statement will perhaps be the most important part of the statement to observe.
So what about some of these programs that you just mentioned here with the QE and sort of what we've been seeing as well in the reaction to some of the consumer debt issues? I mean, they've almost been rejected by the market. How does this affect what happens in treasuries?
Well, the quantitative easing program is certainly one of the largest concerns for the market and one of the reasons why a lot of fixed income investors are avoiding the treasury market altogether because, there are some estimates are saying that the government's going to have to sell over $3 trillion worth of debt this year to fund all their various programs. That's a scary proposition for a fixed income investor. And while in the short term here, 3.9 or 4% yields on the 10-year presented an attractive opportunity. If you're a longer-term investor, you have to be real concerned about the supply that's coming to market, about the quantitative easing programs in play, and what effect that's going to have on your investment going forward. If 4% is attractive to you in the short term, which it very well might be, what does that mean for you a year and a half down the road when yields might be 5% or 5.5%?
Economic data points that we need to watch in addition to the FOMC, ones that, could shift your view of where things go are. I mean, I'm assuming the jobs report at some level.
Well, yeah, I mean, there's a widespread consensus that, labor market indicators are lagging in nature, and that's true for the most part. But the weekly jobless claims number is very much a leading indicator, and we've seen that number come down a little bit, although it's been at about 600,000 job losses per week, 600,000 initial claim filings per week for about 20 weeks now, which is quite an extended period of time. That said, you have seen it come down a little bit, and if you can see additional movement to the downside in that indicator, you're going to we can start getting a little bit more comfortable with respect to the economy and whether or not we are finding a bottom here. But it's really important, and I don't want to get cut off before I say this, to remember that just simply leveling off and seeing an abatement in the decline doesn't necessarily mean that growth is right around the corner. And we've seen this in economies around the world before. Everyone's becoming very excited with respect to economic performance going forward in the back half of the year. To what degree that actually materializes, in my mind, remains a great unknown.
Okay. All right. Well, the great unknown will continue to watch. Depend on you for some insight there. Dan Greenhaus, thanks very much. Dan Greenhaus of Miller Tabak.